NVIDIA's up after disappointing on a sales forecast. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, chip superstar NVIDIA staging a comeback this morning after its forecast failed to impress demanding AI bulls.
Meanwhile, farming equipment giant DEERE sees lower profits next year as the industry faces a wild card from Donald Trump's policies.
And sweeping changes underway at 2 Sigma. The hedge fund is cutting roughly 200 employees after a strategic review. All of that and more coming up. But let's take a look at these markets. 30 minutes to go. As Matt said, you actually have NVIDIA up a little bit pre-market, about 1.3% or so. That is giving a lift to these equity markets. We were pretty lower in pre-market trading, but then NVIDIA staged that comeback. Like Sonali said, you add it all together, the S&P 500 up about 0.4% pre-market. You have big tech outperforming a little bit right now, up about 0.5% or so. A little bit of a bid coming into the bond market. Of course, all eyes on Russia and Ukraine and what is going on there. That's good enough for a little bit of a haven bid. You can see 10-year yields down by about 2 basis points. We have broken below 440, Matt Miller.
I got this chart from my producer, Will Shaker, this morning. Dan Curtis gave me nothing. Check out, these are Magnificent 7 valuations, PE with the forward PE. What do you think the top line is? It's not NVIDIA. That's Tesla running away from the pack. NVIDIA's still down here with the rest of the group at 36, and it could go a little bit lower today. So we're going to keep an eye on these valuations. They're not sky high with the exception of one.
Didn't know Billy did charts. We're going to have him make them more often. We're going to watch some stocks now as well. We're going to look at DEERE pre-market up about 1.7%. It's interesting because DEERE lowered its profit outlook for 2025. It sees more weakness in the industrial spaces, and farmers are hesitating to buy new machinery. That gets more complicated, of course, when you think about tariffs. We'll talk more about that later. Snowflake surging on demand for its newest software. It plans to buy AI data aggregator Datavolo. You have Snowflake up almost 25% pre-market. And finally, as we've been talking about, NVIDIA beating estimates for the most recent quarter, but its forecast did not impress investors last night. You still, however, as we've been talking about, are seeing NVIDIA shares up 1.8% pre-market, Matt, and you are near that record high.
Yeah, I'm surprised, frankly, that we're seeing NVIDIA shares climb. I was patiently waiting at my Bloomberg terminal yesterday at 4:20, saw each headline come across the terminal and said, yeah, that's not really impressive. Okay, that's not a surprise. Okay, that was in line with expectations.
It was your own expectations.
Just not blowing away, well, me and the market, right?
Yeah. Well, think about what we heard from Jensen Huang. He said that the Blackwell products will ship this quarter, actually. He said there's very strong demand. Of course, you wouldn't expect him to say anything less than that.
Things are going okay.
But even still, I mean, they are having to spend more to get them out the door. But even still, I mean, we know that everyone has told us that NVIDIA has such a lead on the rest of the field here. There is so much demand for these chips. I mean, okay, maybe it didn't meet the very top of the expectations.
They're supposed to beat and raise, beat and raise, beat and raise.
I mean, it could be a strategy too, you know, under promise, over deliver next time.
Yeah, and it does absolutely tell you here that everyone went into yesterday saying, you know, we're near record highs for NVIDIA. This is as good as it's going to get. If they miss at all anywhere, it's going to be a big problem. Obviously, it wasn't, which bodes very well for investor expectations heading into next year.
Yeah, I shouldn't complain, I guess, about that growth. For more on NVIDIA, we're joined by CJ Muse, Cantor Fitzgerald, Semiconductor equity research analyst. He has an overweight rating on the stock with a $175 price target. CJ, I mean, is Katie right? Have they changed their beat and raise strategy? Are they now under-promising to over-deliver next quarter?
Yeah, good morning, Matt. Thanks for having me. I don't think it's a change in strategy, but I do think that it's reasonable for a modest reset to, you know, growth expectations to then start more meaningfully beat and raise into January and April as Blackwell truly ramps. So, you know, I do think that you are going to see a reacceleration in their business, data center business starting in the April quarter, and I think that's a key catalyst ahead for them.
So not a change in strategy, perhaps a reset here, and maybe the market had gotten a little greedy after that 200% gain. But let's talk about Blackwell, of course, supposed to start shipping this quarter. One of the concerns heading into this number was that maybe customers were holding off on their Hopper purchases to hold out for Blackwell. Are you seeing any evidence of that?
No, I don't think so. I think what you're seeing is that everyone is taking whatever they can get. So the challenge, quite frankly, is limited CoWoS packaging supply as well as HBM. So on the call last night, they talked about how Hopper was probably tracking flattish into January, and that's really NVIDIA deciding where to appropriate, the limited HBM memory capacity that they can find. So, I don't think that's the case at all. The good news is that, you're seeing Hynix and Micron ramp capacity. You're seeing TSMC ramp CoWoS. And so I think that you're going to see a very, very strong ramp for Blackwell throughout 2025. And, the bull case is $220 billion plus in data center revenues. And I think that's absolutely achievable.
When you think about the price target that you have on NVIDIA, it's funny, I would walk in today normally asking about the downside risk, particularly because of what Matt was saying earlier, this idea that they did not meet the highest of expectations. What is the upside risk, actually? Because you kept your price target at 175. What do you need to see from them to raise your price target?
Sure. So, I think the chart that you put up earlier highlighting Tesla PE versus everything else, really highlights how NVIDIA's strength in terms of the stock performance has really just been in line with the strength in the fundamentals. And so if you assume kind of a 30 multiple for, the most important AI company on earth showing the greatest growth, not crazy, right? And I think that the bull case for the buy side is $6.25. You're probably talking $8.26. And so, thinking about a $250 kind of price target over time is not unreasonable.
All right, I got to say about that chart, I know we keep flying it, and I love all the colors on it, but I think we should take Tesla out of it. It makes NVIDIA and everything else look cheap, but we're still talking about, of course, valuations in the mid-30s. The S&P 500 is at the mid-20s.
Okay, but for NVIDIA, that's nothing, right? I mean, they have been trading at 70, so double that. So it's only half of their highest valuations. They're only trading at 20 times sales.
Are you telling me to zoom out here?
I don't think people are greedy in terms of valuations on NVIDIA. Just because the price has run up, you have to look at what revenue and sales have done, right? They do more in sales than Intel does in yearly revenue.
CJ is talking about almost 70% upside in the stock over time, too. So, what kind of PE does that imply? Well,
if they continue to double revenue and grow sales at like 70% margins, it's not a huge PE. Yeah, remember, the stock price has to be viewed in terms of the earnings power of the company. My thought, CJ, is on the downside risk that who needs to train these things outside of the hyperscalers? I mean, if I'm going to implement AI in my business, as long as I'm not AWS or Azure, I only need to inference. So why am I paying for these terribly expensive processors and reinforcing my floor and bringing in a plumber to do liquid cooling? Like, why don't I just go with Samba Nova or Cerebras?
Yeah, sure. No, it's a great question. I think, first and foremost, you never stop training your models, right? And so when Jensen delivers a new product every 12 months, you're going to want to benefit from that, increased compute power. And so, you're now talking Blackwell, and then you've got, Rudin coming next year, and you'll have something the year after. And so I think what you're going to see is, buying new GPUs to train, pre-train, post-train, and then you're going to repurpose, your old GPUs for inference. And then on the inference side, we're seeing, real-time increase for scaling there. And ChatGPT Strawberry announcement was critical in highlighting how if you spend more time in inference, the greater, the capability of the output. And so I don't think, things are slowing. And very importantly, last night, Jensen, to the question of whether large language models are stalling out, he emphatically said no, and that we're, still very early. And on top of that, highlighted the need to update, $1 trillion worth of data center to support the AI needs. And so if you believe in those two things, then you've got a path, very importantly, for growth in 2026. And that is the key question for investors. And if you can get that growth in 2026, then NVIDIA is moving up and to the right.
CJ, just quickly here, even the NVIDIA bears tell me that you think about the competitive moat that this company has, and it's hard to argue with that. But that being said, you think about all these companies that are trying to whittle away at that lead, AMD in particular, racing to catch up with NVIDIA here. You think about what's going on with the competition, you overlay it with the valuation, which may be justified by the fundamentals. How long can NVIDIA keep the lead here?
Well, they've got the first mover advantage. They built the software stack CUDA starting in 2005. And AMD, is in the market just in the last couple of years. You talked earlier about Samba Nova and Cerebras, and obviously those are smaller players that are trying to, enter the fold. And you also have custom silicon, at the big hyperscalers. So I think you really have to parse through the end markets. Internal workloads are going to be balanced between GPUs and custom silicon. And then I think the enterprise is absolutely going to go with NVIDIA because of their software stack and their needs for flexibility. So I think that there is definitely a place for everyone that you mentioned to have a role. But I see, no change statement in NVIDIA's leadership in this market, in the coming 5+ years.
All right, CJ, great to get some time with you. That is CJ Muse of Cantor Fitzgerald. NVIDIA shares up 2% pre-market, adding to this year's rally of 194%. But it's not all about NVIDIA. Let's take a look at some of these other stocks moving ahead of the opening bell with Abigail Doolittle.
Indeed, and sticking with the AI theme, take a look at the shares of Supermicro up nearly 7% or 6% at this point after yesterday. There was an update. They've received a NASDAQ non-compliance notification. This does not have any effect on stock trading. NASDAQ cited timely filing requirements, and Supermicro has submitted their plan addressing the delay. Investors, at least right now, taking this as a bit of a relief, and there is, of course, a nearly 20% bearish short interest on this, so this could be another reason for some of those super bears to get out. Turning to the shares of BJ's Wholesale Club Holdings, we are going to see a nice gain here as well, up 3.6%. They beat on earnings by about 26%. They also boosted the full year outlook. They've hiked the membership fee. Digital is strong, so all things are well with BJ's Wholesale Club, it seems. So this bifurcated consumer, the haves and the have-nots among some of these big box stores continues. And then finally, rounding it out with the crypto space, Merrill Holdings, which is crypto related to clean energy, up 11%. And of course, yesterday we did receive the word that President-elect Trump is considering some sort of a crypto board, crypto department headed by someone who could be named. On this, we have Bitcoin approaching 100K. So this crypto space is soaring higher, Sonali.
Abby, thank you so very much for taking a look under the hood. That is Bloomberg's Abigail Doolittle. And coming up, President-elect Donald Trump still needs a Treasury secretary. Days and days of searching. We're going to bring you the latest on that search next. This is Bloomberg.
Let's get now to high interest. A look at what's making headlines around the world. Russia launched an intercontinental ballistic missile at a central Ukrainian city, according to Ukraine's Air Force Command. If the strike is confirmed, it would be the first ICBM launch since its development during the Cold War. The Kremlin referred questions about the strike to Russia's defense ministry, but said Russia is taking a responsible position to avoid a nuclear conflict. And U.S. prosecutors are charging Indian billionaire Gautam Adani with helping to drive a massive bribery scheme. The charges allege that Adani and other defendants promised to pay more than $250 million in bribes to Indian government officials to win solar energy contracts, and concealed the plan in order to raise money from U.S. investors. A spokesman for the Adani Group denies the allegations. President-elect Donald Trump's transition team has been busy naming cabinet picks, but the search for a Treasury secretary continues Apollo's CEO Mark Rowan is among the candidates for the role, along with hedge fund founder Scott Bessent, former Fed Governor Kevin Warsh, and Senator Bill Hagerty. I'm sure you have all of those names memorized by now and know the story inside and out, just like we do. We'll bring you any developments as they come. Katie?
Yes, we will. But in the meantime, let's take a quick check on futures right now because we're close to session highs, at least in the pre-market. Of course, NVIDIA shares up by more than 2% right now. You can see that reflected in your big benchmarks. The S&P 500, 0.5%. You see the NASDAQ 100 up by about 0.6%. And small caps, don't ignore the small caps. The Russell 2000 also up about 0.5%, Sonali.
You like to see it when the love is evenly divided, don't you? We're going to discuss the market moves and talk about equilibrium with Nadia Lovell. She's senior U.S. equity strategist at UBS Global Wealth. Love having you today after NVIDIA earnings because it sets the stage quite nicely to talk about where NVIDIA, where the Mag 7, where the AI trade falls relative to the broadening trade that everyone was so excited about. Why broaden when you can bet on NVIDIA?
I do think that the broadened trading is important, and we are seeing that. It doesn't have to, we continue to say, it doesn't have to be at the expense of tech, and that's what you're seeing, because there is cash on the side. And we do think that, you know, NVIDIA is important for the AI trade. It is important for tech. It is important for the overall stock market, and it continues to reiterate our view on AI and the opportunity there. We think that the AI opportunity is huge. It's, you know, over $1.1 trillion opportunity revenue across the value stack by 2027, and this is why we continue to favor tech and have it as our most attractive sector, because we think that the spend is going to continue. When you think about what the 4 largest hyperscalers are spending, we think it's going to be over, you know, $250 billion in capex, and most of that going to AI next year.
Interesting. So you can't ignore the AI trade. You can't ignore tech, of course. You take a look at your S&P 500 targets. I see you've penciled in 6,600 for the S&P 500 December 2025. It sounds like the leadership that's going to take us there is big tech in your view.
We continue to think that tech is going to lead, but again, it's not going to mean that you're not going to see the broadening out. We do expect some of the cyclical areas of the market to also catch up. We've seen a strong performance from financials recently, and we think that that's going to continue into next year. Remember, we have a yield curve that's now steepening, and we know that that's positive for financials. We have the potential for an ISM manufacturing, which has been below 50 for quite some time, potential for that to start to rebound next year, and that could help some of the more cyclical areas of the market, and you have a Fed that's cutting.
As we have started to talk more and more about NVIDIA and its driver position, we've stopped talking about the Fed, really.
Yeah. Do you want to talk about this?
Does it matter?
It does matter. It does matter, particularly for those other areas of the market and that broadening out trade. You know, right now the market is pricing in a coin flip for December cut, which we don't think is unfair. I mean, reality is when you look at the recent inflation data, it is running a little bit hotter than the Fed had penciled in for year end, and the rhetoric has started to be a little less dovish. We know Bowman, she's hawkish. We know that, and she has said that, you know, there seems to be a stalling out of the progress on inflation, and so it doesn't seem that she's inclined to cut in December. But you do have Powell that's also saying that, you know, it's not in any sort of hurry right now. We do think that you still get a 25 basis points cut, but that a lot of that is going to depend on what happened in the macro data from now until then, especially on the job markets. And we think that the Fed's pace, the cadence, will probably slow in 2025 to more of a quarterly pace.
You know, it's interesting. If you were here yesterday or a day ago, we wouldn't be talking about NVIDIA or the Fed. We would be talking a little more about the consumer because of the really choppy numbers you got out of those consumer companies. If you have hawkish Bowman here, if you have worries about how much the Fed can cut, then really how much do you have to start worrying about the consumer again and their ability to juice up the stock market, right? They're a huge part of what pushes this economy forward.
Absolutely. Consumer is a big part of the overall economy and spending, but the consumer is still spending. I mean, let's be clear about that. It's more about the mix shift. That's shifting what they're spending on. We're seeing continued softness in discretionary spending, but you know, the consumer is still out there traveling and eating out and things of that sort. And so remember, the consumer propensity to spend depends more on the labor market. And we are continuing to see income growth, and we are seeing a labor market, you know, put aside the October numbers. We know that those were noisy, but we think that the labor market still remains quite healthy. If you looked at the data earlier this week from the state level data and employment, it suggests that, you know, all of the noise, the storms, probably contribute about 110K pressure on the labor market. So labor market's probably growing somewhere between 125, 150K in terms of jobs creation every month. And that's still pretty healthy, and you still have some income growth as well.
The consumer's really interesting because it's not necessarily playing out at the sector level like you would expect. We talk about inflation all the time, maybe the weakening consumer a little bit. We have seen pockets of that. Then you take a look at year-to-date performance at the sector level. Consumer staples, that sector only up about 14%. Then you take a look at discretionary, for example, outperforming, at least staples. Make that make sense to me.
Well, it's one stock, consumer discretionary
Tesla.
Recently.
Yeah. Staples,
First Buddy is outperforming. Basically, that's what's happening with Tesla in the recent performance. But yes, I think that's a fair question in terms of, I mean, what you wanted to see in Staple this year is really volume growth, right? You remember, Staple has been benefiting in the prior years from inflation. Inflation is starting to come down, and so you really want those companies that are able to grow volume, and that's the pressure that you're seeing within Staple, the ability to see volume growth.
We refer to Elon Musk as the co-president-elect.
There you go.
It's an unelected position.
If you're elected president, can I be your first buddy? I love
Yes,
it.
yeah, you can join me at all my rocket launches. Nadia, thanks so much for joining us. Nadia Lovell there from UBS Global Wealth. Later on today on Bloomberg Television, we're going to hear from the CEO of Palo Alto. That's at 11:30 a.m. Eastern on Bloomberg Tech. This is Bloomberg.
All right, welcome back to Open Interest. You take a look at futures right now. We're at pre-market highs on the S&P 500, on the NASDAQ 100. Small caps getting in on the action as well. And less than 4 minutes to go until the opening bell. We're going to take a look at all of these earnings names. Of course, DEERE, Snowflake, and of course, NVIDIA. All of that and more coming up. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Kind of a lackluster report from NVIDIA last night, and nonetheless, futures are rising. S&P futures up 0.5%. NASDAQ futures up a little more. Small caps are gaining, too. You hear the opening bells on the New York Stock Exchange. You have the people of BlackRock promoting a couple of ETFs. BAI is one, and TEK is another, which I think, that's thematic, considering NVIDIA was last night. Down at the NASDAQ, apparently Mr. and Miss or Mrs. I'm not sure if they're married.
They're married.
Mr. and Mrs. Met there, along with one of the greatest closers in baseball history, I'm told. John Franco there. Check on the averages. For that, we go to Katie Greifeld, standing by with gains. Katie.
I know that you are unimpressed by what we learned from NVIDIA last night, but CEO Jensen Huang said that they're seeing very strong demand for Blackwell, and it seems like, I don't know, traders are taking him at his word. You take a look at the averages right now. The S&P 500 currently up by about 0.4%. We're not quite at 6,000, but we're, within knocking territory. You take a look at the NASDAQ 100. That's where all of these gains are being expressed. The NASDAQ 100, your big tech index, up about 0.5%, but it's the small caps that are in the lead. Of course, we're going to be focusing on small caps at 10 a.m. But for right now, just know that the Russell 2000 up about 0.6%. Meanwhile, we are still in earnings season, so let's talk about DEERE right now. It lowered its profit outlook. Farmers are spending less than they did on the onset of the war in Ukraine. There's also concerns around tariffs, how that may impact the index, but you can see the stock just shrugging it off, basically, currently up about, call it 3%, Sonali.
And I'm watching Snowflake over here because this is a stock that had a lot of pain this year, Katie, but today is a very good day. It's up about 27% as the market opens, the biggest gain since 2020. After reporting strong sales growth and plans to buy AI data startup Datavolo, gives it some access to unstructured data, helps it get a little closer to that Anthropic universe, becomes a more interesting AI play, Matt.
All right, so AI in focus. Obviously, NVIDIA is the biggest beneficiary of the craze. It posted a big quarter and beat estimates on sales and on profit as well. Data center revenue doubling year over year, but investors are debating whether the company can maintain its growth or at the same pace that it has been, because Abigail Doolittle, it was beat and raise, beat and raise, beat and raise, and they didn't do it like that this quarter.
Well, at some point, the music is going to at least slow, which it seems to have done in the quarter that was, and the raise that is for NVIDIA, and maybe at some point even stop. We've been talking quite a bit about how even though the growth is phenomenal, it's decelerating, and at some point to well below 100% growth. So investors may be uncomfortable with that. And it's also interesting that the strength was from data centers. But here's a check at the AI that entire complex. NVIDIA, a nice 3.6% gain, but not the volatility that we were all looking at. Sort of a dud here for NVIDIA. In fact, AMD higher, super microcomputer higher, having more to do with the fact that it survives another day on NASDAQ. And then ARM Holdings up 3.4%. So overall, we do have the AI complex intact today. Taking a look at chips more broadly, because of course the Trump administration coming in and the expectation of a protectionist policy. These are numbers for South Korea. One of their big industries is chips. And on a year-over-year basis in November, growing 77.1%. So very strong. Interesting, that's ships. And then chips at 43%. Although for some reason, I think that is maybe supposed to be flipped. But in any case, lots of strength for both ships and chips out of South Korea. So it's going to be interesting to see whether or not the Trump administration in some way does provide protectionist policy that dings that, or other countries, chips being one of the big poster childs for the idea of what tariffs can do. And for for chips overall, while South Korea's numbers might be strong, investors are a little bit concerned. This is a big bearish consolidation pattern. It's considered a diamond top. If we blew this out, you'd see big gains. So people bought really well way back there. They've been taking profits all year long, but they don't want to do it all together at one spot because then they might disrupt their ability to take profits. Well, you can see the Sachs clearly below the 200-day moving average, breaking below this consolidation pattern, suggesting that this entire pattern may in fact break to the downside. If that happens, Katie, maybe tariffs that could come into play with the new administration are going to hit the chips complex.
All right, Abigail, great stuff as always. Let's keep this conversation on chips going now with Allspring Global Senior Portfolio Manager Margie Patel. And Margie, I hear Matt's point that, okay, NVIDIA didn't exactly fulfill the most bullish fantasies that were out there. But as a money manager who is heavily invested in the semiconductor complex, what did you make of what we learned at 4:20 p.m. last night?
Well, the most important thing was that the demand is still very, very strong for as far as the eye can see. And whatever little bit of disappointment was in our performance was maybe on supply glitches. So that's a problem that will solve itself. So I think it really did is affirm that the strength in artificial intelligence is real, data centers is real, and that really is a vote of confidence in the whole tech sector to continue to have way above average growth into next year.
But for the people who are looking to broaden the trade here, do you think that there's ample opportunity to do so, given where you saw the forecast lean toward?
Well, I think that the idea that the growth will broaden out to all stocks is really not pretty unlikely, because the economic growth is still pretty modest for the year, 2.8%, maybe 1.5% to maybe 3%. And so that doesn't say to me that the more marginal players will be able to have big increases. So I think the growth will continue to be those tech stocks that were leaders this year, industrials that were leaders this year, and a few other stocks like that. And that's where the growth is going to continue into 2025.
But do we continue, Margie, to see the kind of growth that we have been with NVIDIA? What did you say it was up 200% year to date?
Yeah, it's year to date.
I mean, yes. Sales I get are doubling. The margin is still great, but it's compressed, right? Now it's only 70%. Are we going to continue to see the stock tripling in a year?
Well, I think you're going to continue to see very strong earnings growth, leadership among the stock market. However, I do think we're going to see continued, which we started to see already, erosion in the price earnings multiples that these companies are trading at, really reflecting the fact that as we go through time, the earnings growth rates are going to decelerate, so the PEs will shrink a little bit. A lot of the return so far this year was really price earnings expansion rather than earnings growth equal to some of the performance we've seen in stocks. So we think next year will still be a good year, but more modest, because we don't think we'll see PEs expand the way they did this year.
And Nvidia right now, in the first few minutes of trading, it's pairing gains now down or now up by less than 1%. And as such, you see the S&P 500 little changed at this moment. And Margie, looking into 2025, if we do see maybe some decelerating growth from Nvidia, we aren't expecting another 200% rally next year. What does that mean at the big benchmark level? Because it kind of feels like we're getting used to those 20% plus gains.
Well, that's right. But then a lot of that was, I think, PE expansion for many, many stocks. So I think the earnings will continue the same path they've been, which is growth around 8, 9, 10%. There's no reason why the economy should slow down because corporate profits really haven't decelerated. But I do think we're likely to see that PE erosion. And that would say next year we may see much more modest gains and way above 20% this year, say something more matching the profit growth of 10, 12, 15%, something like that for the stock market.
You know, it's interesting. In the first 8 minutes of the trading day, Margie, it's been a pretty interesting set of moves here. You've had the S&P futures in the morning start out higher. They are now lower, the biggest drag being Alphabet at the moment. And Alphabet, of course, we know is fending off what you're seeing over at the Justice Department, trying to have them separate Google Chrome, to have them sell it, to curb monopolistic powers here. When you look at that kind of overhang on big tech, particularly Alphabet, does it concern you on broader indices at all, like the NASDAQ 100, or even just the broader Mag 7?
Well, I think it has put a little cloud over Alphabet. People worried about what these actions will be. Actually, we've seen actions by governments over the past, say, decade trying to rein in some of big tech. And really, it hasn't changed the fundamentals, which are these companies are leaders in their field. They're growing faster than all their other competitors. And even if you chip away with some kind of corporate edict that they have to follow, I think they'll still be very, very strong stocks. It doesn't change the fundamentals of their business.
Margie, thanks so much for joining us. Always great to get insight from you, especially when we get these chip makers reporting. Margie, Patel, they are coming up. DEERE sees more challenges next year as farmers hesitate to buy more equipment, but investors are still bullish. This is Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Palo Alto Networks getting raised to a buy at Rosenblatt Securities. The firm highlights Palo Alto's strong first quarter performance and says that the security software company's strategy is driving larger deals and bigger growth. Next up, HSBC says that Target is no longer a buy. The firm downgrading the retailer to a hold after it cut its full-year profit outlook yesterday after a disappointing quarter. The downgrade is the latest sign that Wall Street is losing patience with the retailer's turnaround plan as Walmart continues to gain ground. And finally, we have William Blair saying that Ulta is no longer a buy, cutting its recommendation on the beauty retailer to neutral. The analyst says that there's a longer-term risk embedded in the beauty category, and he sees more uncertainty ahead, Matt.
Yeah, I have to agree. There's more uncertainty to come. Let's talk about tractors right now. DEERE joined rivals CNH and AGCO in lowering its outlook for 2025 as farmers spend less on equipment than they did at the onset of the war in Ukraine. Of course, that's the breadbasket of Eurasia. Now, the industry is also bracing for tariffs from the incoming Trump administration. Let's discuss with Bloomberg Intelligence analyst Chris Cellino. So, Chris, what's the story look like for DEERE? Because it didn't look great to me, lower than expected profits next year, and yet investors are bidding up the stock today.
Yeah, you're right. I mean, the 2025 guidance wasn't great, but buy-side expectations heading into the print were very, very low. A number of their competitors reported big misses and cut their outlooks this quarter. So I think the outlook here is maybe a little bit better than some investors had feared. That being said, the farm economy is still quite challenged and will be again next year. I think there's growing optimism that 2025 will kind of mark a bottom in the cycle. The worst of this large ag inventory destock seems to be behind us. So the magnitude of those production cuts should begin to moderate as we move through next year. Those are the positives. I don't think we're completely out of the woods yet, though. And I think it's still maybe a little premature to call a cycle bottom. One, farm fundamentals continue to remain weak. And two, we're on the precipice of another trade war with our largest ag customer. So we think this really runs the risk of extending this downturn.
Speaking of, I want to pull up now a chart for the full year for DEERE because it was a really weak year last year. This year has been sluggish as well. But the worst of the pain in the stock actually came well before the election. And after the election, you did see a dip off, but then a rally back up. And so I'm wondering how much real risk there's not being priced in right now when it comes to those trade tensions and the impact it could have on the stock.
Yeah, it's significant. I think the trade uncertainty is real, and I don't think it's fully appreciated yet. And I think uncertainty is like kryptonite for capital spending on farm equipment. Farmers are not going to go out and spend until there's better trade visibility with arguably our largest customer. How exactly this unfolds, nobody's 100% sure yet. So I still think farmers will take a wait-and-see approach to spending.
Let's get more specific when we talk about trade. I want to talk about tariffs in 2025 because, of course, President-elect Donald Trump, he's threatened tariffs specifically on any products that DEERE makes in Mexico and then sells in the U.S. You're talking about farmers here, but talk about DEERE, for example, and how you approach them as an analyst. How do you potentially model that into their results in 2025?
Incredibly difficult. I do think the biggest risk here is with China because, they are the largest buyer of our crops. We sent nearly $30 billion of ag exports to China last year. That was 17% of all of our ag products. They're the largest buyer of soybeans. That is a big, important crop, particularly for DEERE and row crop farming. Then you throw on top of that additional tariffs on other regions like Mexico, which is still also an important buyer of our crops. It could be incredibly complex and difficult to model this in, to say the least. And again, I go back to my point of, if farmers don't have any kind of visibility on some of their relationships with their largest customers, they're just not going to go out and spend.
What about other costs that they deal with? I mean, in the event that fuel becomes less expensive, and I know prices at the pump have been coming down, but we could see even more relief in the event that electricity becomes cheaper. Do farmers then have more to spend on equipment? Is that kind of a jump you can make, a leap you can make?
No, I don't think so. Certainly to help with their P&L a little bit, but ultimately at the end of the day, what drives farmer income and farmer profitability is crop prices, and they get that through corn, soybeans, wheat, and selling to some of their larger customers. So that was ultimately what's going to drive demand for DEERE.
Chris, we have to leave it there. Thank you so very much for all of your analysis. That is Bloomberg Intelligence Industrial Analyst Chris Ciolino. Now, coming up, we're going to go into the hedge fund world. Two Sigma cuts 200 jobs in its biggest restructuring in the hedge fund's history. We're going to look at the shakeup next in our Wall Street Beat. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's get a check on the stock market right now. We're about 20 minutes into the U.S. trading day. You can see we're trying to decide what to do right now. The S&P 500, it opened about 0.5% higher. We erased gains, of course, as NVIDIA swings back and forth. Currently higher by about 0.2%. A real tug of war going on in the NASDAQ 100, though. The shares of Alphabet down pretty mightily at the moment, to the tune of about 5%. NVIDIA shares higher by about 1.7%. You add it all together, your big tech benchmark only higher by about 0.1%. The small caps just merrily rallying along here. The Russell 2000 currently higher by about 0.7%. That has been your outperformer over the last several weeks and potentially months here, and it is certainly your outperformer today, Sonali.
Merrily, are we feeling a little holiday vibes here?
Moving merrily along.
Anyways, we're going to go now to the Wall Street Beat. The hedge fund firm Two Sigma cutting about 10% of its workforce after a strategic review by the company's new co-CEOs. Bloomberg's Hema Parmar has the details. She co-wrote the story today, which is now one of the most read on the Bloomberg terminal. You can find it at Bloomberg.com as well. two new CEOs, one who is kind of a longtime employee, one who came from the outside, was the legal counsel over at Lazard, now helps lead Two Sigma as a co-CEO. Why do they think, after this feud between the co-founders, that cutting 200 jobs would be the right move?
Yeah, so this is really the first big public sweeping change we've seen them make at Two Sigma, which is where the two billionaire founders were in such a dispute and such a long-running multi-year feud that they stepped down. And so these two new co-CEOs running the firm, cutting 200 staff, 10% of the firm, in a way to, they would say probably, to be more efficient and to try to streamline the firm a little bit more. There had no portfolio managers have been let go, but it's been more people on the operations side, the coding, the more like slightly back office.
By the way, I thought you were going to say, why did they think co-CEOs was a good idea again? After they learned the first time it was a horrible idea.
I actually know these guys, and for this purpose, Scott Hoffman has an easy touch. He's led a lot of transitions over at Lazard twice, actually.
I just mean most times co-CEOs is a bad idea.
Otherwise, it's
Everybody knows that,
Yeah.
and yet they do it anyway.
Co-presidents.
Yeah, that's
also
a very good point.
works.
By the way, it makes sense to me. I mean, I feel awful, and as I'm sure they do for anyone who loses her or his job. But we saw Brevin Howard do the same thing earlier this year, and it is about efficiency in a lot of cases, right? You get bloat, you get too many people working in the same kitchen.
Too last year.
Yep.
And Brevin Howard has done very well.
Yes, yeah. So 10% of job cuts in Brevin Howard sometime this year. Schoenfeld also, after they went through a lot of changes and a lot of tumult with Millennium, they had job cuts as well. So you do see some streamlining at these firms. And you're seeing some of these firms, they've gotten so big, there's been a talent war, they've staffed up, performance has been great. And then they get to a point when they're like, all right, we need to really take a look at ourselves. Brevin doing very well, having their best year since 2020, I believe, on bets related to the election, and it's working out very well. This is a macro trading firm, and so you saw that they bet quite well around the election recently.
So you've seen job cuts at some of these other hedge funds, but there are some idiosyncratic nuances going on when we talk about Two Sigma. You think back to that public feud between the founders, John Overdeck, David Siegel, which was playing out in public filings, which were fun to follow. I have to imagine this stems out of that, these sweeping changes. Are there more to come?
There are more, likely more changes to come, unclear about any more job cuts. But this is a firm where the difficulties between the two founders got so bad that it was impacting staff, it was impacting hiring, retention, and it was so bad that the firm actually put in their filings, regulatory filings that are public, that it counts as a conflict and it counts as something that could impact the firm and impact performance. And so that's a very rare thing for any hedge fund to do, let alone a firm as secretive as Two Sigma.
All right, fascinating stuff. Hema, thanks so much for joining us. Hema Parmar covers hedge funds for us, and you know, Sonali does as well. In fact, today, Sonali has a pretty exciting interview with one of the most recognizable faces of the hedge fund industry.
First, huge shout out to Hema and the team here. And Hema Nishant is breaking so much news this week. And when you think about it, what's interesting to me about this is Two Sigma really having to change course. It's not an easy world out there for quants anyway. Well, no, one of the big questions I have for Ken Griffin is he told Nishant this week that multi-strats, the boom times are kind of over. So we're going to get into that a little bit today and what he sees as the future of the hedge fund.
This is my main point, is that you're going to interview Ken Griffin today. That's what I'm trying to say.
I've been knee-deep in questions.
He has had a lot to say this week. I mean, just looking over at the terminal coverage, for example, he's investing in nuclear. He says it's the future, the boom in multi-strats being over. Interesting to hear that from
anxiety about trade wars.
Yeah, it's fascinating. Looking forward to that.
All right, so at noon, right? At the
noon.
Economic Club of New York.
Exactly.
I'm trying to promo this interview for you.
Thank you.
Coming up in the next hour, Goldman's Greg Tuorto shares his 2025 outlook with a focus on small caps. Then we're going to talk to the CEO of Range Energy about electrifying trailers. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. We take a look at markets at this juncture, trying to decide what to do, of course, on the S&P 500. You have NVIDIA shaking off yesterday's report, but then you have Alphabet shares like a weight, and you can see that reflected in the S&P 500, now down about 0.1%. We also have economic data that we're keeping an eye on when it comes to existing home sales, coming in a touch above expectations, 3.96 million in the latest reading, slightly higher than the survey reading, Matt.
Yeah, looking also at the leading indicators, the leading index here, down a little bit more than expected. So a little bit of a mix, although both are pretty close. And also, does the economic data really matter compared to NVIDIA?
This one doesn't, honestly, is because, yes, they rose, and they rose well, honestly, the most since February for contract closings. But this was when mortgage rates were still facing a slight decline. And as we know, they have been picking up from there. Yeah, and as such, not much of a reaction in markets right now. So let's sail along, because joining us now, I am so excited for this conversation. We're joined by Greg Tuorto. He is Goldman Sachs Asset Management Portfolio. He has a focus on small caps. He manages an actively managed small cap ETF. You don't see a lot of pure play active managers in small caps in the ETF wrapper, which I find interesting. And Bloomberg Intelligence has done a lot of work on your industry, finding that you take a look at the universe of mutual funds and ETFs that cover small caps, and active managers have been cheating up a little bit, if we want to call it that, basically overweight large caps and underweight small caps. And as someone who's been in the space for a really long time, I'm curious what you make of that dynamic.
Yeah, thank you for having me. We've heard a lot about that from clients, where they really want to make sure, what's in the cereal box is what's on the cover of the cereal box, so to speak, in terms of if you're a small cap manager, you should own small caps. And I think that dispersion has come about after 3 really tough years that small caps have had. Not just underperforming large caps, but if you go back to 2021, there's been a number of headwinds that have hurt the small cap market that have been unlike many things I've seen in my career. So it's not unheard of, but I think it's gotten to a point where it's quite noticeable right now.
Well, one of the reasons I keep hearing for why we're seeing this play out is that there haven't really been very many true small cap IPOs. The companies are staying private for longer, and then they're debuting as mid caps and large caps. And I'm curious what challenge that poses for you as someone who is truly in the small cap space.
Well, we don't, I think we feel that our style is benefits from that, because I think that we have a deep team, we're well resourced, so we can actually look at a lot of the companies that are, that have been public for some time, which represent valuation opportunities. There have been some IPOs that have been out there that are unique and interesting. We expect that to pick up, meaningfully, kind of soon and into 2025. But I do think that does, represent a challenge for some people who do spend a lot more time on the IPO market. The companies come out, they're bigger, and if that's your new idea list, that's what you're going to be choosing from.
It's a golden moment right now for small and mid caps, and there are a lot of questions in the market on how to enter the space. People have been buying into the index, but when you look at the ETFs that you're in, very, 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 very specific stock selection. What are the ingredients of what you pick?
Yeah, so I think that one of the things that we try to differentiate ourselves from is sort of the broader small cap indexes, because I do think that there is some kind of problematic nature to the fact that many people think that there's a lot of unprofitable companies in there. And I think that comes from the IPO boom of 2020 and 2021, when you had SPACs and biotech companies that were coming public in large volumes. If you look today, we look through a quality filter to kind of build our portfolio, bottoms up, one stock at a time. And I think that allows us to be not just focused on quality at the portfolio level, but at the stock level, where it actually matters.
What's the best setup, maybe economically, for small caps? I mean, do you want to buy them when the country is in a recession, when it's coming out of a recession, when the Fed is cutting rates? I mean,
in the past, it's been, kind of when the Fed stops, starts to cut rates, or right after a presidential election. So I think you have those two twin.
Sounds like now.
Right. So there's twin tailwinds, and I think you've had some fits and starts. I think where you've had some, kind of opportunities. July, people tried to get ahead of it. Right after the election, you saw that, that huge move in small caps the Wednesday after the election. So I do think you're starting to price that in. Some of the worries people have are whether the Fed's going to pause in December has been a bit of a road speed bump, so to speak, in that. But I do think that, if you have a stable economic environment, like which we think you do, stable and growing GDP next year, I think that those two twin tailwinds should hold into a, what we think should be a really strong year for small caps.
I just heard the phrase again this morning, cash on the sidelines. I've been doing this for 25 years, and I've been hearing that phrase way too much in that entire period.
We need to keep a penny jar here.
What's really cash on the sidelines? And when in your career have you seen it?
In crises. In crises, I guess you'd see it when there's really cash on the sideline. Most professional money managers who run active mutual funds or ETFs, they're not going to be sitting there with 5% cash because that's not what people pay them to do. I do think that cash for us is frictional, and I think most of the people that I think of as professional money managers think about it as like, what you're going to do with your next idea. Where's it going to come from? Most people don't have a zero-sum portfolio, meaning you have to sell something to buy something. If an analyst comes to you with a new idea, you want to have the cash to put that to work, especially if it's timely and interesting. You don't want to have no cash, but I do think that the misnomer is more in terms of the household, the retail investor who keeps cash on the sideline and those large and growing money market balances that you see from the BAML fund manager survey that comes out that shows that mountain of cash that's sitting on the sideline.
Yeah, it's just wild. I mean, according to Crane estimates, $7 trillion in money market funds. It's just stunning. But I want to get a little bit philosophical. This is something that we've talked about previously, but I'm going to ask you the question again. The $2 billion ceiling on what designates a small cap, does that still make sense in this market?
Well, we use $2 billion as sort of like an entry point into small caps, and our benchmark is where you look at an average of like $3 to $4 billion as where the small caps live, and they can go up to $6 billion. So I do think that there is a wider range of small caps today. I think if you want quality, if you want liquidity, you really have to start at that $1.5 to $2 billion range, and I think that that's where we look in terms of making sure that we have a company that's got a good balance sheet, it has a management team that's been tested. And I also even think that, even with the apathy towards small caps of the last 3 years, once you go below $1 billion, you're giving up a lot of liquidity and quality down there that you may not want.
So no micro caps?
No, we stay away from micro caps.
Really quickly here, too, you made this great point about the broader index and all of the leverage that's in those stocks. I mean, if you think about the wall of worry there, the amount of distress you could find, do you think that things can get pretty choppy for small and medium-sized companies in the next year or so?
Yeah, I think that we've seen a lot of the damage in that kind of dynamic that's already happened. I believe that you're seeing spreads have been very, very tight, even with some of the things that have been going on with the 10-year. So I'm not really worried about credit, and I'm not really worried about some of the the companies that have a floating rate exposure on their balance sheet. So I don't worry about that as much, and I don't worry about it at all for our companies.
Greg, we thank you so very much for your time, of course. Join us again here in studio. That is Greg Tuorto of Goldman Sachs Asset Management, of course, on a part of the market that a lot of investors have watched very closely. We're going to now get to stocks moving this hour that investors are watching closely. We're going to bring in Abigail Doolittle.
Let's start out with a bit of a stealth laggard, and this is Google. Take a look at the shares of Alphabet, down 5.4%, the worst day since either July or January. This after the DOJ yesterday put in a late-night filing, a final push asking a federal judge to force Alphabet to sell Chrome. Investors clearly not liking this possibility, and you can imagine that if the judge were to agree with the DOJ, one of the Biden administration's last pushes as well in terms of their big antitrust agenda, that may not be such a good precedent for Alphabet, not to mention big tech in general. Turning to a big winner, though, in the tech side, Snowflake soaring up 30.2%. Citi saying that this is a strong redemption quarter. They beat, they raised, and you basically do have a very big day here for Snowflake, up 30.3%. Turning to Coinbase Global, this is interesting because we do have crypto marching higher, Bitcoin going toward $100,000 per Bitcoin on the Trump administration's support, the new Trump administration support for crypto. Coinbase not joining in, this as their CEO has sold 19.1 million shares in common stock, or dollars in common stock. Not so much a dilution, but maybe a sentiment issue here. So this is the odd crypto stock out on the day, Matt.
All right, very interesting. See Coinbase down 5% on a day when we're talking about Bitcoin 100,000. Abby, thanks very much for that. Coming up, electrifying trailers to help the tractor. We'll talk to the CEO of Range Energy about how he's trying to revolutionize commercial transportation. Ali Javidan joins us next. This is Bloomberg. Getting out of high interest, look at what's making headlines around the world. The International Criminal Court issued an arrest warrant for Israeli Prime Minister Benjamin Netanyahu and former Defense Minister Yoav Gallant. The ICC accuses the two of crimes against humanity as well as war crimes. The ICC unanimously rejected Israel's appeal. The warrant means that ICC's 124 member states would be obliged to arrest Netanyahu and Gallant if they were to enter one of those territories. Netanyahu has previously called the ICC's application for arrest warrants absurd and false. Two Sigma is cutting 200 jobs. The New York-based hedge fund is dismissing roughly 10% of its employees following a strategic review. No portfolio managers were included in the dismissals, according to Bloomberg sources. Departments affected include corporate, engineering, securities, and modeling and trading. The review comes after the hedge fund's founders stepped away from day-to-day management because of a years-long feud. And the art world is going bananas after a crypto entrepreneur bought a controversial piece of art at auction, specifically a banana duct taped to a wall. The price tag, $6.2 million. The piece, titled Comedian, debuted at Art Basel, Miami in 2019. The image attracted such massive crowds that the work had to be removed. For his $6 million and change, the buyer will get a roll of duct tape and a certificate of authenticity. The banana is not included since it will rot and need to be constantly changed for display. Unbelievable. All right, Range Energy is bringing electrification to commercial transportation. The company makes powered trailers that can easily hook up to any tow vehicle, diesel or electric, to extend the range of the trucks. Joining us now is Ali Javidan, Range Energy CEO and founder. And Ali, I've been following your career for a long time, listening to you on various podcasts from when you started at Tesla until now. But I think this is a fascinating company that you've started. You don't just sell powered trailers, but you can also electrify existing trailers to hook up to then a diesel tractor or an EV truck that really extends the range. What kind of extension are we talking about?
I think what we're building here is a very flexible solution for these fleets. And if we look at each one of these fleets, they're all individually different. And so for the range extension, it really depends on the route that the fleets are taking. But we're seeing increases in fuel economy of over 50% for anywhere between 200 and 300 miles, depending on the lane.
I would imagine truckers want to get hold of these trailers or electrify their own trailers right away because it's a moneymaker for a lot of truckers are independent businesses, right? So it's not just about the bigger contracts, and I know you've closed some of those, but it's really about the individual businessman or woman who's driving a truck long haul. I imagine they can save so much money this way. Yeah,
I think we want to be able to not only address the large fleets, but very, very importantly, we want to address the smaller fleets as well, because we understand that there's a tremendous amount of pressure to decarbonize for any of these fleets. And the smaller fleets are the ones that have the most difficult time doing that. And that's why this solution is really meant to be flexible, very, very quick to deploy, and something that the drivers of these small and large fleets really want to adopt because of the safety and the convenience of the technology.
And I know that the commercial EV industry is very different from the individual level, right? People buying EVs just for their own personal use. But you think about the big stumbling block when it comes to personal EVs, it's the charging infrastructure. It's that range anxiety. But when it comes to the commercial EV industry, how often do these need to be charged? What does that network look like?
For electric tractors, it's a very cumbersome and burdensome solution. You have to have really, really high power infrastructure. You have to have very expensive hardware in your yard to be able to charge these tractors, these electric tractors. Our solution is a lot more like the passenger vehicle space, still with commercial hardware, but we're able to actually charge these trailers in a much more efficient and convenient way than the tractor charging requirements. For example, we can actually charge at the loading dock in the same amount of time that it takes to load and unload the box. And what that does is that eliminates any operational disruption that the fleets have.
Because they don't need to be charged on the road.
They don't need to be charged on the road necessarily, and also you don't need to pull the tractor out of the trailer out of circulation to start charging it. You can actually charge it while it's actually performing its duty.
I want to go back to an earlier question Matt had because, you were talking about the cost savings, but how do the economics work? Bring us through the plumbing of this, because what is the upfront cost and how do you get that back over time if you're buying one of these?
Yeah, I think, again, every fleet is different, so the payback period is going to be different based on applications and lanes and things like that. But I'll kind of give one quick anecdote. Typical route, let's say Bakersfield to Las Vegas, which is a typical trucking route outside of California. A tractor trailer will typically get about 6 to 8 miles per gallon. We're getting around over 15 miles per gallon on our standard diesel tractor, and that equates to quite a bit of fuel savings every month, over 50% in fact.
We're showing a lot of pictures of eggs. People might wonder, because we're going to have the CEO of Vital Farms on next, but another egg supplier, Petaluma, has just closed a contract with you, and it made me realize that the electrification isn't just for propulsion, right? You can drive the trailer along with the truck, which helps them, for example, climb up a hill faster. But you can also power a refrigerated vehicle, so it's actually offering more benefits than just the drive.
That's right. Our trailer acts as a power platform so that not only can you use it for propulsion, but you can also use it to power the refrigeration units, which is also another pollutant in our network.
Normally it'd be powered by diesel.
Normally it would be powered by a small diesel engine that sits in that refrigeration unit, burning about 1 to 2 gallons per hour of diesel.
Interesting. So I want to talk a little bit about the political landscape. Of course, we've been talking about the election for the past year, and I imagine that politics are front and center for you as well. EVs have become a politicized term, usually when it comes to personal EVs. When it comes to the commercial EV industry, when it comes to your business, what does the Trump administration look like for you?
I think we're very confident that we're going to continue to deliver this product to our customers. I think regardless of what administration comes in, and frankly, we're all kind of waiting with the rest of the world to see what happens over the next few months. More important than that, though, is getting these trailers in the fleet's hands so that the drivers can start using these trailers. And ultimately, regardless of what the political landscape looks like in the future, it really boils down to how are we making the drivers feel safe and comfortable doing their job every day. As we know, these are the most important people in this network.
Ali, I'm really interested too, to the point about politics here. Maybe we won't get as much subsidies from the United States, but, you know, electrification is something investors are still interested in. Capital-intensive business, I imagine. What are your fundraising needs, and can you see yourself going public?
I think one beauty of doing the trailer and not the tractor is that we're not the primary mover. So our content is dramatically less. We don't have to develop roll-up windows and air conditioning systems and things like that. And so our cost to getting to commercialization is dramatically less than a primary mover, and the investors love that. So as far as IPO goes, we'll see what the future lies.
But financing has been?
Financing has been great. We have a lot of really great investors, and we're optimistic about the future.
All right, very cool. I'm going to have Ali on my podcast as well.
When is it?
Well, we're recording it now, but we'll put it out next week because he's also.
Where can you find your podcast?
You can find it wherever you get your podcasts, on Spotify, on Apple Podcasts, on Bloomberg.com. It's called Hot Pursuit with Hannah Elliott, because he also happens to be a car aficionado and apparently a very good driver as well. Very familiar with suspension issues after his work at Tesla. Ali, thanks so much for joining us. Ali Javidan there of Range Energy. Still ahead, Starbucks hoping a revamp of its business in China will give the coffee chain the jolt that it needs. Details next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, it's going to cost you more to walk into BJ's. BJ's Wholesale Club is raising its membership fee for the first time in 7 years. The discount retailer said membership will cost $60 a year starting in January. That is about $5 more than what it is right now. The announcement comes 4 months after competitor Costco raised its membership for the first time since 2017. Next up, Bloomberg has learned that Starbucks is considering selling its stake in its Chinese operations. The coffee giant is facing pressure from activist Elliott Management to review its Chinese business. Now, in the past, both McDonald's and Yum Brands have carved out their Chinese operations and sold stakes to private equity firms to tap more growth and better cater to local tastes. And finally, Clear Secure. It's the service that theoretically lets travelers cut security lines. It has a future that's anything but clear. The travel service has over $700 million in revenue, but its growth is in question after a series of security lapses. Clear often ends up being slower than TSA PreCheck, which of course is the agency's cheaper and less flashy service. And now the TSA is rolling out its own facial recognition technology, which could make Clear redundant. And guys, I know you both have a lot of feelings about this, so tell me about them.
Well, I mean, like the millions of other people who have an American Express Platinum card, I get Clear for free. My wife does not. So we will, or used to, now we don't even bother anymore, put her in the regular TSA PreCheck line and I'll go in the Clear line to see who gets there faster, and I'm always slower with Clear.
Every single time, same goes it. I mean, I have both. PreCheck is what gets you there faster, and I don't know what to say. I mean, it is a very frustrating system in a lot of ways for whoever's used it. So yeah, but it was, remember when it came out how necessary it was.
Well, when it first came out, and apparently like Lisa Mateo uses it at Yankees games, I can see that there are other applications.
I have used it at sporting events, track events, etc. Not at the Olympics though, but in any case, I don't know, maybe the TSA will come out with a bigger, better version. In any case, we're going to talk about eggs next. I'm really excited.
I think we all love eggs.
Yeah.
Is that fair to say?
No.
Do you not love eggs?
I stay away from proteins.
Wow.
As much as I can.
Interesting. Coming up, it's the best performing stock. We'll talk about Vital Farms with the CEO next. This is Bloomberg. Well, Vital Farms stock has been the cream of the crop. The company is up nearly 90% this year. That makes it the top performer in the food and beverage category. Vital works with nearly 300 family farms in the U.S. to bring ethically produced food to your kitchen table. Joining us now, I am thrilled to say we have Russell Diez-Canseco. He is the CEO of Vital Farms. And you take a look at the stock performance, you take a look at some of your recent earnings reports. I feel like you have the happy problem of you have a lot of demand and you need to boost supply. And this quote from your latest earnings call, I loved that quote, "Our challenge right now, as always, that I can't get the chickens to lay more eggs in the short run." Let's talk about that, Russell. How much do you have to spend to ramp up production from here?
Yeah, so it's great to be with you today, and I know a lot of people are familiar with our Vital Farms eggs, but many people may not realize that we went public in 2020 and that we've grown to nearly $600 million in revenue, and our food is available in over 24,000 stores in the U.S. So yeah, we're seeing a lot of growth, and in fact, you mentioned at the top that we have nearly 300 small family farms that we partner with. Well, since that statistic, we're now up over 375 small family farms. So we are growing at a rapid clip, and we plan pretty far ahead for that. You know, the spending to grow this brand and this business is self-funded. We are a profitable, fast-growing business. We're building additional capacity, and that additional capacity is well within our ability to fund from our own earnings.
Russell, why does the food industry make it so difficult to understand how the animals are treated? And then, when you're at the grocery store, I don't know the difference between cage-free or, bio is what they call it in Germany, free range. Yeah. And fortunately, on your eggs, it says 108 square feet per chicken. But then if I'm looking for milk, if I'm looking for actual, chicken meat, if I'm looking for beef, I can never tell. Have you found a solution to that?
Yeah, there's a lot of confusion at the shelf. And unfortunately, in some cases, there are a lot of misleading claims out there. Increasingly, what consumers are telling us is that first, I need to trust you. I need to trust the company producing the food, and then I'm going to trust you to make a lot of decisions on my behalf. So whether it's what we call our standard for eggs, which is pasture raised, and the amount of space we give our chickens, which is 108 square feet per bird outside, there are myriad choices we're making every day to create transparency and trust for our brand and with our consumers.
the price of eggs in the last couple of years has been a very kitchen table issue, right? I mean, it has very much been the case where eggs have fluctuated in prices quite meaningfully. What are kind of the ingredients going into next year on what could cause more price volatility? Because certainly people have been feeling the cost of eggflation. Haha, sorry.
You had to go there.
I did.
We play in two categories, eggs and butter, that, as you said, are absolutely consumer staples. They're at the center of the plate in many cases, and they're at the center of the grocery cart. And there have been a lot of factors that have led to egg prices increasing, along with lots of other foods over the last few years. Our own prices have gone up, although to a much lesser degree than eggs overall. I think that the biggest drivers for the industry, for those commodity egg producers out there, are going to be input costs, the grains that they feed the chickens, and maybe some other costs of production. Our eggs are a very high quality product produced in a very thoughtful and ethical way. And some of those choices cost more. And so our eggs do cost more than some others. But we think it reflects the value we're creating and the additional care we put into producing them.
Well, Russell, one of the big reasons over the past couple of years why we've seen that fluctuation in egg prices is because of avian flu, for example. And I'm curious how that's impacted the family farms that you work with and how pressing of an issue it is at this moment compared to the last couple of years.
Yeah, avian influenza is certainly a big topic in this industry, and I think in America. And it's certainly not a topic anybody is taking lightly. I would say that of the tens of millions of birds that have been killed by avian influenza and by the industry's response to culling flocks in order to stop its spread, the vast majority have been in big, concentrated factory farms. Most of those chickens are kept in cages, which is sad, and I think maybe reflective of an outmoded way of thinking about caring for animals and producing food. Yeah, our over 375 small family farms are spread out across several states. And so while 4 of them in the last 2 years have been affected by avian influenza, we were able to get those small farms back up and running quickly, and it only affected less than 1% of our total production.
How quickly can you scale? Because for 108 square feet per hen, I imagine land is the biggest impediment to that.
You might think so. One of the great things about our model is that there are tens of thousands of small family farmers in this country who look to Vital Farms to provide an opportunity to have another source of income, often from land they already own. See, our chickens don't use cropland. In fact, they love rocky outcroppings and they love to walk among the trees. And so using that part of your farm that maybe you didn't have another good use for is perfect for what we do. And it doesn't require a lot of new land to be taken out of some other means of production.
I do want to talk a little bit about farms. You mentioned that 4 of the family farms were impacted there. Out of almost 400, it's not too bad. But you work obviously with family farms, but I know that Vital Farms is also ramping up accelerator farms, for example, as you deal with some of these supply issues. Talk to us about what exactly an accelerator farm is and how you plan to balance the family farms versus the accelerator farms.
Yeah, first of all, I'm excited about accelerator farms. It's a handful of farms that we're building to operate ourselves, not to replace or in any way change our model of working with our small family farm partners. It's actually more of a way for us to do our own R&D, our own learning about how to help all of those family farmers be even more successful in the future. So for us, it's not so much a change in the way we think about growing our supply. It's a way we think about improving the outcomes for our stakeholders, in this case, the farmers.
So there are the farms, there's you, and then there's the means of distribution as well. You can buy Vital Farms products over at Whole Foods, for example, and I'm wondering what you can tell us about how that food chain really works. And, by the time you get to the grocery aisle, what's the markup and what's your relationship with the grocery stores themselves?
Sure. Well, there's a lot to unpack there, but the headlines are we're available in over 24,000 stores in the United States today. And I think that has a lot to do with the fact that, one, more and more consumers are demanding our products every day. And so grocers are finding that they need to offer that to their shoppers. Second, we make sure that we're a great answer for the retailer. The retailer, the category manager for the egg section, for example, has goals. They want to grow their business profitably, and they want to meet the needs of their consumers. And our products do that. We partner with them to make sure that what's good for us in business is going to be good for them as well. And that helps us grow together.
Russell, great having you on the program. Hope to get you back soon. Russell Diez-Canseco there of Vital Farms. Let's get a check-in on what's going on in the broader markets right now. For that, we go to Bloomberg's Abigail Doolittle. Abby?
It's interesting, Matt, because right now we do have the S&P 500 down by about 0.4%. The NASDAQ 100, I believe, is lower as well. And a big piece of it is big tech and NVIDIA, which had been up 3 or 4% earlier on sort of this lackluster quarter and guide, now down 2.8%. So certainly not the 8% move up or down that options had been suggesting could happen. But as the biggest weight to the S&P 500 and the NASDAQ 100, as goes NVIDIA, today we have the S&P 500 following. NYMEX crude oil, WTI crude, up 1.5%, still below $70 per barrel. But of course, as it appears that the Ukraine-Russia war is escalating to some degree, that is putting a bid beneath oil. And then Bitcoin, on the possibility that the future Trump administration is going to be friendly to crypto, which they're all signs seem to point in that direction, despite the fact that in his last administration that was not the case. We have Bitcoin closing in, not quite there right now, but up 1.5%, closer to $100,000 per Bitcoin than not. If we put this into the technicals, this is an absolutely parabolic move out of the election. This is a non-logarithmic, or excuse me, this is a logarithmic chart, so it doesn't quite show that. But what I would like to point out, even log form, you can see how steep the angle is, not quite 90 degrees. Very similar to February of 2024, earlier this year. And then you can see once that uptrend breaks, as the RSI, the momentum, starts putting in lower highs, we had Bitcoin sort of move lower, 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 and then even go close to $50,000 per Bitcoin. There's a long-term uptrend that makes it seem that Bitcoin will likely consolidate back down. The RSI, though, suggesting we really could see Bitcoin pop back above $100,000 per Bitcoin or thereabouts, and then maybe consolidate. And then finally, movers beneath the surface, starting off first with two winners to the upside. Snowflake up 30.3%, the best day since 2020, a big beat there and a guide for their product revenue. DEERE, the outlook not as bad as feared, up 5.6%. Palo Alto Networks, that is down 1.4%. Their billings declined, and plus the guidance for the current quarter for revenue, the low end below. And then finally, this is another big drag. This is actually the worst drag for the S&P 500. Google, Alphabet, down 6.1%, the worst day, I believe, since January of this year, as the DOJ is seeking for a federal judge to force them to sell Chrome.
Yeah, a story we've been talking about a lot. Abigail, thanks very much. Abigail Doolittle, they're running through some of your movers. Of course, we are going to have the CEO of Palo Alto Networks on this network in just about an hour's time. Also going to talk to Guenther Steiner, former Haas F1 team principal, discussing Formula One racing, which this weekend,
Whoa.
Las Vegas, baby.
Okay.
It's coming up in today's Wall Street Week conversation. This is Bloomberg. It is time now for our daily Wall Street Week conversation. Guenther Steiner is one of the most popular figures of Formula One. David Weston spoke with the former Haas F1 team principal about what it takes to win on and off the racing track.
F1 10 years ago or 12 years ago was not what it is now. At the time, quite a few teams went out of business because there was no revenue. It was just a cost, and it was just, it's still difficult. It was difficult to get, some results in. So what it took, write up a business plan, go out there and find an investor. And then what you need to do is you need to get a license, which at the time, it wasn't easy, but it was a lot easier than it is now these days, because now with the teams valued highly, A lot of people try to get in, but there are 10 strong teams now in F1. At the time, there were a few weak teams. And, you know, when there are a few weak teams, the authorities, they were a little bit more lenient. They said, yeah, we put another team on the grid if it can show that it is sustainable. We obviously had to show that we are sustainable for at least 5 to 10 years, that Mr. Haas, Mr. Gene Haas, the investor, had enough money to fund it for 5 to 10 years. That needed to be proven. We needed to tell the FIA and FOM, which at the time was owned by Bernie Ecclestone. It was run by Bernie Ecclestone. It wasn't owned by him anymore, but it was run by him to show that we can contribute to the show of F1. And then obviously when you get all that, you get the license, you get the authorities to agree on, you get a signature on the commercial contract that you're part of the revenues which F1 generates. You need to put together the team with the people to actually go and design a Formula One car, which by no means is easy. They are very complex machines. The technology is very high. And you need to find a partner which gives you the engine, because obviously just a few people or just a few companies produce engines, because they are very expensive to make and very difficult to make. So, and once you've got all that one together, you needed the right people to make it happen. You need a design team, you need a wind tunnel to develop your car aerodynamics, you need a race team, you need a commercial team, you need all the administration, and then you can go racing. And that is how we did it. With Haas, it took about, from the word we got the license to the first event, it took a little bit less than 2 years to make this happen.
So, wow, that's what I would say. That is a lot of, so I can say, moving parts. So let's start with something you referred to, which is the cost. Can you give us a general sense of how much it costs to run an F1 team for a year?
I think there is a difference. Obviously, there is a cost cap now in F1 since it's about, I think we are in the 4th or 5th year of the cost cap. So there is a cost cap for the operational spend. There is a cost cap for the CapEx spend, for the capital investment spend. But there is no cost cap, for example, for the drivers, for the travel budget is outside of the cost cap. The 3 highest paid individuals are outside of the cost cap. The social security is outside of the cost cap. But to get to your question, operational, it's about, I would say it's now about 170 million in the cost cap. Plus you've got a cost cap of around 50 to 60 million on capital investment.
That was David Weston speaking with Guenther Steiner. You can catch Wall Street Week every Friday at 6 p.m. Eastern. And, of course, the races are in Vegas this weekend. Meanwhile, Bloomberg's Eric Schatzker is sitting down with PIMCO CEO Manny Roman at Evidence AI Symposium. Let's listen in.
Maybe a couple of seats for the Democrats. The margin you have to kind of make any significant cuts is much harder than we think it is.
I asked you about where the potential upside is. I think you answered my question already, the one I was about to ask about where the potential downside is. The potential downside would seem to be inflation.
Yes, the potential downside is you have a quick series of tariffs where the markets say that there's too much debt in the system and that all of a sudden you see the back end of the curve rising, and then you reset inflation expectation. The Fed looks at this and say, our job is to fight inflation. The Fed needs to do a 180 and raise rates. It's not the central scenario, but it is possible. Now, what I'm saying is understood, I think, hopefully by most members of the new administration. And as they set their policy, I think they clearly understand the binding constraints of what they have to face.
Did we just lose Manny's mic? We did. Do we have a stick mic that I can give him? Talk again.
Hello? I didn't.
It's good? Fine.
All right.
So we might not have hardcore bond market watchers in the audience, but I'm sure that you pay passing attention to where the 10-year yield is. Since the Fed started cutting rates, we have seen the 10-year yield, let's just say, has not followed rate cuts.
You're seeing a steepening.
Yes, a steepening. Now, the Fed may not have lost control yet of the long end of the curve, but
I don't think the Fed controlled the long end of the curve. I think the Fed has. I think that's one of the things that people sort of, the Fed controlled the first 18 months of the curve, And after that, the market.
It's the market.
It's the market.
So if you're the incoming
Treasury
Secretary, and we'll get to whom that person might be in a moment.
That's, of course, PIMCO's Manny Roman speaking with Bloomberg's Eric Schatzker. You can continue to follow that conversation by typing Live Go on your terminal. This is Bloomberg. The field of candidates for Treasury Secretary is narrowing, but it still remains in flux. Scott Bessent, Mark Rowan, Kevin Warsh all interviewed with Donald Trump yesterday, but allies and advisors to the president-elect say the president-elect has yet to completely be sold on a choice. Joining us now, co-host of Balance of Power, Kayleigh Lyons in Washington. And we talk about this so much because it's such a critical part of the economic team. What does it say that there's so much of an issue in choosing one in the first place?
Well, that there is kind of contradictory qualifications that the president-elect is looking for here, Sonali. We know, based off of our reporting, our wonderful colleagues Saleha Mohsen and Nancy Cook has done a lot of this, that he's looking for someone who looks the part, who has the kind of Wall Street pedigree and the wealth that impresses Donald Trump and therefore has credibility in his mind with Wall Street. But he is also looking for someone who aligns with him on policy when it comes to things like tariffs and crypto, and that may be a missing link as we try to check all of these boxes here, which is why no decision has yet been made. That's not to say that one couldn't be coming soon. We're all waiting and watching, but there's also the potential for a kind of sleeper or dark horse candidate, like, say, Republican Senator Bill Hagerty of Tennessee to emerge here, who has proven himself, of course, to be very loyal to the president. In fact, just announcing on X a short time ago that he'll support the president-elect's defense secretary nominee, Pete Hegseth, despite concerns around qualifications for that job, as well as allegations of sexual assault back in 2017. So a lot of this is going to come down to loyalty as well. And keep in mind, while the Treasury position, of course, is critically important in terms of economic policy, also important are those roles that will be inside the White House. National Economic Council Director, for example, and the Council of Economic Advisors.
Right. And some of these names, of course, are being considered for that job as well. We've reported Bessent for that. But the four names that it seems that we've centered on, for example, is it possible that it's not any of those four names? You think about Matt Gaetz, for example, getting named for Attorney General. I don't think anyone was expecting that.
Yeah, it's completely possible, Katie. We know this president-elect, as was the case during his first presidency, does have the power to surprise. We've already seen that with a number of his selections for the second administration. We do know, though, that he wants to make sure the markets aren't dissatisfied with his choice. He doesn't want to have that kind of disruptive impact in terms of financial markets. And so that may lead him more toward not wanting to have a completely out of the woods candidate on this one and someone who is still going to be able to maintain the credibility. So it might not quite have the shock factor as some of his other nominees, keeping in mind that he campaigned by and large on the issue of the economy. So his economic policy team is going to be critical, as he says he's going to make good on all of these different promises he made on the campaign trail, and he wants to have the people in place to do that. I would remind everyone he was only elected 2 weeks and 2 days ago. So while this process has moved very quickly to this point, he still has plenty of time in this transition window here to make this selection.
Right. A good reminder there that we're still in November. Kayleigh Lyons in Washington. Thank you so much. Meanwhile, a quick check on these markets right now. The S&P 500 pretty much flat on the session. NVIDIA, of course, posting losses now has flipped into the red. Alphabet shares down by more than 6%. That's weighing on the NASDAQ 100. As you can see, Matt Miller down about 0.3%.
All right, coming up tomorrow on Open Interest, we have another double dose of CEOs coming for you. Roy Gorey of Manulife and Mark Baracus of Shark Ninja. This is Bloomberg.